Well, good morning. Welcome to this Path to Profit video series. My name is Jim, and I'm recording these videos in hopes that one day when my kids are old enough and become interested in trading, they have something to fall back to begin their trading education journey. You know, much like we did in the early years with VHS tapes and beta home recording devices. Um, I thought the best place to record and archive this knowledge would be on a YouTube channel. So if you stumble upon this channel, welcome. I hope you can put this information to good use. Its intended purpose is to be educational, started with foundations to teach the mental and psychological aspects of trading. These are some of the most important lessons that I feel are mostly lacking from courses and information supplied by online gurus. So this is video 3 in the series. We're going to talk about how markets move. If you want to catch up, there's 2 previous videos already uploaded, episodes 1 and 2, which go over common mental mistakes and things that you need to overcome. So watch those videos. You can jump back on this one or watch this one, however you choose. They're there for your education, and I hope you gain some knowledge and foresight to help you not make a lot of the beginning introductory mistakes that most traders make. So without further ado, let's get started. Like I said, my name is Jim. This is a Path to Profit video learning series that I'm recording. So I'm going to start with a little story. In the 2002 film Spider-Man, Peter Parker wakes up after being bitten by a radioactive spider. He discovers he has this superhuman ability like enhanced strength, agility, and the ability to sense danger through his spidey sense. What initially seemed overwhelming to him becomes his greatest asset as he learns to harness it. Similarly, in trading, being able to anticipate what other traders are thinking is like developing your own spidey sense for the markets. Far from a curse, it's a superpower that you can use to give you an edge if you know how to use it. In this foundational step, we're going to show why markets move, how markets move, and why this is the critical basis of trading that most traders gloss over, then forget about it and lose money because of it. We'll finish this section with candlesticks to demonstrate the power you'll have when you can see basic candlestick patterns and what they mean. They give you the best visual indication of what other traders are thinking. So why do markets move? For the most part, everyone involved in trading wants to try to explain the why. Why did prices move the way that they did? Why does a given indicator work? Now, there are tons of books, courses, and chat trading rooms and analysts that'll go to great length to explain the why. The reality is that the why seldom matters. We look at what price is doing. That's what matters. Now, there are 2 critical things that every trader needs to know. Why do the markets move, and how do the markets move? It's only after you understand and have internalized these 2 things that you will be able to effectively utilize all of the other tools and techniques that you will learn. Now, you can go into any business class in any school and they will tell you it's supply and demand. And that sounds pretty good. The price of a thing will move based on how much that thing is available, which is the supply, and how much people are willing to pay for it, which is the demand. Some also say it's because of fear and greed, the fear of losing money and the greed of wanting to get more money. Now talk to the guy on the street and he'll tell you they're just a bunch of crooks and the markets move because traders have inside information. The guy on the street may be a little closer to the actual reason the market moves, but not because of the inside information part. although there very well may be a certain amount of market movement because of inside information. Think about this for a minute. An individual person walks down a street in the cold winter weather. They know where they want to go, and they're only 5 blocks away. They're focused on where they want to go, and they see a crowd gathering. Maybe there's something they should know about. They walk towards the crowd. They can't see what's going on, but the crowd is moving. So they move with it to try to see what's happening. The warmth of the crowd is comforting in the cold weather. They still can't see anything, so they keep moving with the crowd. The crowd seems to be slowing down. Maybe they'll get to see what's actually happening now. Suddenly, they're getting pushed by the crowd in a different direction. What's happening now? Did they make a mistake by following the crowd? Are they even safe? The crowd is moving faster. They had better keep moving to avoid whatever the crowd is running away from. After what seems like a few blocks of action, they decide that maybe they should just leave the crowd. They manage to get away and look up to see where they're at. They find themselves 30 blocks from where they were originally, and they don't seem to have their wallet or their coat anymore. So the guy on the street was closer to correct. It's the traders. It's the collective action of the crowd of traders that moves the market. It's not the theories, supply or demand. It's not the news. It's not the geopolitical action of world leaders or of even individual countries. It's the perception of those things and even the mass of traders, the crowd, and what they think or more aptly feel at the time and how that affects their fear of loss and greed at any moment in time. An individual thinks and acts in a certain way based on experiences and the education of that individual. However, when you expose that individual to a crowd, they tend to become the crowd and lose track of their individual education or the things that they know. They lose track of their individual morality, the right and wrong that they've known for years. They really become an unthinking mass of human energy that is different than the sum of its individuals. You can talk to any policeman. Their interaction with an individual is totally different than with a crowd. They can reason with an individual. They cannot reason with a crowd. Trading is not too far from the same situation. However, while trading, we don't try to control or direct the crowd. As individual traders, we don't have the power to do that. As individual traders, we only recognize the crowd and see what they're doing. There's almost no way that we can trade for any length of time without becoming part of the crowd. It's critical to be able to stay away or stay on the outside edge of the crowd so that you can separate yourself at a moment's notice. You can have the best trading system in the world, one that is certain to put you on the right side of 80 to 90% of the trades. However, it is not the trading system that will eventually make you money or make you broke. It is the trader, you, and how well you can get close to the crowd without being sucked into it. How well you can be true to yourself and follow your trading rules. It's how well you can control your own emotions. Actually, there are two distinct sections in the crowd. They fight each other for power. The power to move in one direction or the other. The bulls, which are the buyers, want to move the market up. They are called bulls because of their method of attack on the market. They start with their head low and go up with their horns. The other opposite and competing part of the crowd is the bears. Their method of attack is to stand and swat down with its claws. The bears, or sellers, are trying to drive the market down. Remember, the crowd moves in a direction, and they'll get tired and rest for a while. And if they rest too long, sometimes they get overpowered by the other part of the crowd and move back for a while. And sometimes they continue in the same direction. Sometimes they change their minds, or the opposing crowd takes over and moves in the opposite direction. Each side has the two same basic motivations: fear of loss and greed, which is simply the desire to make money. It all sounds confusing, but it's basic human nature. It's because of that human nature, not the market, but human nature tends to repeat itself in general, predictable patterns. Our goal is to identify and understand those patterns. Identify and use the right tools for the pattern, get in, get out, keep the money, and do it again. So let's move on to actually how the markets move. The markets move because of the mass of people, the traders, and their perception of many different events. Inside that crowd, there are two groups. One wants and or believes the market will move higher, the bulls, and the other group wants or believes the market will move lower, the bears. The bulls and bears go back and forth trying to exert control. Sometimes they make big moves, sometimes they get tired. Sometimes they just lose their way. With all that said, the market only moves three ways. At any moment in time, the market can only move up, which is trending up with the bulls in control, down, trending down with the bears in control, or it can move sideways, which is oftentimes referred to as congestion, where no one's in control. The bulls and bears push back and forth in a trading range. Now let's look at a chart and see what that looks like. This is a chart of the Dow Jones Industrial Average. That's a weekly chart. Let's look at it in sections and try to determine what's happening to the traders. Now look at section 1. In this section, the crowd just seems to be going back and forth or sideways with no real direction. This is referred to as a trading range, a box, or contraction. We'll use some more descriptions later, but that's close enough for now. Now in section 2, it looks like something happened. The crowd is starting to move. The bulls seem to be in charge. Buyers seem to be coming into the market. There are more buyers than sellers, so the prices are bid up. This is also referred to as a trending market or expansion. This particular trend is up. Prices are moving up. The traditional definition of an uptrend is higher highs and higher lows. This is also referred to as a trending market or expansion. This particular trend is up. Prices are moving up. The traditional definition of an uptrend is higher highs and higher lows. The market also has periods of contraction or sideways movement, followed by periods of expansion or trend, which can either be up or down. But who's doing the buying here? Is it the professionals or the general public involved here? What were the cable TV analysts saying? Is the general public afraid that they're going to miss the next big move? Does the public believe it's actually a move? What happened in section 3? Did the crowd get tired and lose its direction? Did the bulls get nervous? Did the market move too far too fast? It looks like it may need time to get adjusted to the higher level. That happens. The bears are starting to move in. More sellers than buyers here, so the price is driven down as either buyers close their positions and take their profits, or sellers feel they can move the market down. Now between section 3 and 4 are 6 weeks that show the bulls regained control of the market and ran the prices higher. This continued the previous trend. Is this another attempt to get in before it really takes off? No one wants to be left behind. Everybody is making money, so let's just get on board. How can you lose is the general consensus at this point. Section 4 is another breathing spell or rest at this new level. In the unmarked section 5, the bulls and bears continue the fight. Possibly more profit taking going on here. Another round of buyers comes in. Greed is reaching all-time highs. No one wants to miss the opportunity to make more money in section 6. This is where the general public actually comes in and does its buying. No one wants to miss out on the big move. They've heard it on TV. The analyst reports they're paying dividends at $600 per quarter and said the market's moving up. It's the word on the street. If the general public is buying, who's selling to them? The professionals. They're taking their profits and running. But wait, what happened? It seems to be the last run up before the peak at 7. The crowd changed direction. The same thing happens only in the opposite direction now with the bears, and fear and charge from a high point of 7. Now this back and forth between the bears and bulls, buyers and sellers, is the market. The expansion and contraction, or the sideways and trending action, is how the market moves. There are trends. They can be short or longer in time duration, and they always are followed by a contraction or a sideways motion. It's like waves in the ocean. It's sometimes referred to as the natural rhythm or cycles of the market. When the market trends, it seldom goes straight up. The bulls charge and move the market up. The bears test the strength of the bulls, and the market retraces or goes back a bit while the bulls regroup and make another run up. Eventually, the market has moved so far that the bulls have lost all their power. At this point, the market moves in a sideways trading range while both sides go back and forth. It can be for a short or somewhat extended time. The bulls and bears are uncertain of who's in charge currently. Eventually, one side will take charge, and the original trend continues or reverses. Let's look at this in another way. The concept of support and resistance are also used in analyzing charts and market movement. Support and resistance are not necessarily finite points on a chart. Traders would like them to be a single identifiable line on a chart, but they are not always that definite. They are better thought of as zones or areas. We like them to be finite lines when possible, but it's not always the case. Markets are fluid and they tend to move. Remember, markets are a reflection of the crowd of people. Sometimes people just aren't certain of what they want. They always know what they don't want, but seldom can come across to a consensus on a positive definition of what they actually want. Support is a price level that seems to act as a floor, the bottom of which prices tend to not go past. Resistance is a price area that seems to act as a ceiling or upper limit of where prices will go. Support and resistance are represented by lines on a chart. Those lines can either be horizontal or diagonal that seems to follow a short or longer trend up or down. And most all traders can agree on where to draw horizontal support and resistance lines. Drawing support or resistance lines as a diagonal line tends to leave more to the discretion of the trader. Let's look at horizontal trend lines for now. Neither support nor resistance is fixed. They both move, but let's look at how they move. Now I've drawn 5 lines on the same chart that we were reviewing before. They're marked A, A1, B, C, and D. Let's look at these lines in relation to the market movement we have already described in the numbered areas. This happens to be a chart of the Dow Jones Industrial Average Index and is a weekly chart. I don't advocate trading it since the margin is 16,000 plus per contract, and we don't trade weekly charts. Now look at section 1. The crowd just seems to be going back and forth or sideways with no real direction. This is referred to as a trading range or box. Look at line A. Is this a support area? Did prices drop below this area? No, prices did not drop below this area. This is support. Continuing with section 1, look at line A1. Is this resistance? Yes, prices seem to stay below this area. In section 2, something happened. The crowd is starting to move. The bulls seem to be in charge. Buyers seem to be coming into the market. There are more buyers than sellers, so the prices are bid up. This is also referred to as an uptrend. Prices are moving up. The traditional definition of an uptrend is higher highs and higher lows. Next, prices move past line A1. They broke resistance. Now, once resistance is broken, there tends to be a continued up move. What happened in section 3? Did the crowd get tired and lose its direction? Did the bulls get nervous? Did the market move too far, too fast? It looks like it needs some time to get adjusted to the higher level. The bears are starting to move in. All these things are happening, but look at line B, a new support line. Look at line C. Would you call that resistance? I would, and it is. You already know that once resistance is broken, there tends to be a continued move up. Look some more. What else happened here in section 6? Remember, resistance once broken tends to become support. Line D, yes, it's resistance. Let's go back and look closer at section 1 and the section to the left of it labeled R. Section R was July through October that preceded section 1. The actual dates are not important, but let's look at line A in section R. Is that resistance? Yes, it is. How many times was resistance tested? How many times did the price bar come close to that area or touch the line and then go back below it? 5 times. It finally broke out on the last bar labeled with the arrow. What happened to the resistance area in section R? It became support in section 1. Look how many times support was held in section 1. 4 to 6 times, depending on what you want to count. Now I pull down the upper edge of section 1 a bit to show a section of line A1 that is highlighted in red. It's actually an extension of section 1. Here resistance was tested 3 times before it finally broke with a close above resistance. If you look in section 2, it is the same as before, but now it's labeled as a diagonal trend line, also showing support that held until it was broken with the first long bar in section 3. Support and resistance are the most basic methods of technical analysis. Some traders have developed total trading methods on this simple concept. If you did absolutely nothing else in regards to technical analysis but support, resistance, and trend lines, and you manage the other aspects of risk and money management properly, you would become a good trader and make money. If you wanted to buy this market, you could wait for a close above resistance as shown, and then buy the next bar at the open. Your protective stop, or how much you're willing to risk losing if the trade doesn't go your way, would be just under support, which was the old resistance. The price move from the start of the diagonal trend line to line C is over $10,000. The risk from the breakout at A1 to support at A is just about $10,000. This is not good risk-reward ratio of 1 to 1. Pro tip here, you never place a trade without placing a protective stop at the same time. Let's go back to the charts. Still looking at section 1, from the start to the arrow that shows where resistance was broken, it's 35 bars. Since this is a weekly chart where each bar represents 1 week, that's 35 weeks waiting for a breakout. Another term used to describe section 1 other than a box or trading range is congestion or sideways movement. Ideally, you would like to get in on a trend. Going long, you would like to buy as close to the bottom as possible and sell as close to the top as possible. Going short, you would like to sell as close to the top as possible and buy back to close out your positions as close to the bottom as possible. It should be no surprise that everyone else wants to do the same thing too. That's problem 1. Problem 2, markets only trend about 20% of the time. That leaves 80% of the time that the markets are not trending and are in some congestion pattern. How can support and resistance help us make money? Let's look at the chart again. This time let's take a closer look and change from bars to candles. First, when you take a closer look, things look different, sometimes cleaner and easier to see. Second, with candles, you can get an immediate impression of what the players are doing. Are there more white candles or up days than black? Down days? In the box marked as section 1? Let's look. 19 white body candles, 15 black body candles, and 5 candles where the open and close were basically the same. Let's also assume that we don't have any information past the right-hand edge of the box in section 1, but the left side is visible. That adds an additional 7 white candles and 7 black candles. That doesn't change things, does it? Maybe it does. What happened in the oval area preceding section 1? Was a previous resistance line broken? Was there a minor 5-candle uptrend that broke resistance? What happens when resistance is broken? It turns into support. It looks like the bulls just made close to a $7,000 run up in the market. Do you think that they may need to rest some time and adjust to the new higher prices? Does this sound familiar? Let's get back to our earlier question. How can support and resistance make us money? Let's look at the chart again with some additional notes. 5 weeks later, the new support line is tested with a down week. We can tell from the solid black body candle. After the market oval and a $6,850 run up in 5 weeks, we don't know what's happening other than resistance was broken. 5 weeks later, the new support line is tested with a down week. We can tell that from the solid black body. It's tested a second time the following week, but it's an up week. The bears tried to push it down, you can tell from the lower shadow, but the bulls remained strong, and a solid white candle was the result. The next week didn't show much movement. It opened and closed in the same place. It had a run up, but the bulls couldn't hold it, and a minor run down that the bears couldn't sustain either, and it stayed in the same place. That candle is called a doji. It's normally a bearish candle. It does not automatically signal a top, however. The next candle tested the support area is indicated by the blue arrow. The following week tested it again with an up week shown by the white candle and then another test of support 2 weeks later. You could say that the open and close of the doji was acting as resistance. This was broken and there was a run up to a high of 11,750 and the first red arrow showing resistance in the middle of the chart. Another run down to 10,750 5 weeks later, the white candle with the long shadow. This is now confirmed a trading box or congestion area. We know the top and bottom of the trading range. Now it's time to try to make some money. We have a target price of 11,750 at resistance. If we place a buy order at or just above support at 10,850 and a protective stop just below support at 10,675, what does this do? We're buying close to support. Our price target is at resistance and our protective stop is just below support. Now let's look at the numbers. Risk, $1,750. Potential reward, $8,100 for one contract. That's a 1 to 5 risk-reward ratio. Since the initial margin on this contract is $16,250, that's close to a 50% return on your money in 8 weeks. Don't worry if you don't have $16,000 in an account. They also have many contracts at about 1/5 the size and 1/5 the margin requirement, and their point value is also 1/5. The total money would be less, but the profit percentages would be the same. It cost you $16,250 to buy a contract. At the end of the 8-week period, you got to keep your original $16,250, and now you added $8,100 to it for a total account size of $24,350. And you did it in a non-trending market in a period of congestion. Most traders are told to only trade trending markets. They've all been whipsawed attempting to find a trend at the beginning and end of congestion periods. And they do this because they don't know you're in congestion until you're actually there. But you were able to identify the congestion sooner. You were able to do this because you understood how the market moves, support and resistance, the concept of price target, protective stop, risk-reward ratio, and why markets move. We didn't discuss, nor did you need to know, the component stocks that make up the Dow Jones Industrial Average, the P/E ratios, management, economic outlook, market share, or products of any of the component companies. We didn't discuss, nor did you need to know, anything about our national debt, trade deficit, global warming, geopolitical conditions of the Middle East, China, South America, Europe, or any of the old USSR countries or Russia. We didn't look at or discuss any of the above fundamental data. We didn't even discuss the basics of supply and demand. All those things foster opinions. Different people could look at the same data and come up with totally different assessments based on their individual education and experiences. No, we used basic technical analysis. We looked at the chart. All those other things are taken into consideration by the big money people. Everything is reflected in the price and the movement of the bulls and bears as shown by the candles. When two different people look at a chart, they both see the same candles or bars. They both can see where the last high and low was, and they both can draw the same horizontal support and resistance lines. The difference is your knowledge, motivation, account size, and because you understood support and resistance, the concepts of price target, protective stop, risk-reward ratio, and how and why the markets move. We'll review other things that are out there that other traders may be using, but in the end, we always look at price and what it's actually doing. Also, how we're going to react to the prices, staying with the basics of support and resistance, the concept of price target, how to place a protective stop, a good risk-reward ratio, and how and why markets move. It's because these basics allow you to get in, get out, keep the money, and do it again. These basics allow you to be a successful trader so you can enjoy your life. I hope you took something away from this video. Again, I'm not a professional videographer. I'm a guy who has learned how to make money in the markets. Trading isn't hard. The act of placing a trade is easy. The hardest thing you will do is learn to manage your emotions and stay true to your trading plan. This is crucial. In the next video, we're going to go over the basics of swing highs and swing lows. If you stumbled upon this video by chance, it's part of a series teaching you the fundamentals of how to learn how to trade. I'm breaking these concepts down into the basics that a beginner can easily follow. Each video builds upon skills learned in the previous video. So please go back to the beginning and watch the other videos, and I'll see you on the next one.